Wir sind Via Printo, Ihre Spezialisten in Sachen Online-Druck. Immer individuell beraten. Ihr persönlicher Ansprechpartner ist für Sie da. Und zwar vor, während und nach Ihrer Bestellung.
Ladies and gentlemen, welcome to the second webinar of our IR week. The webinar is titled Equity Macro and Sector Strategy Outlook and will be held in English. Let me first start with some organizational notes. You can see a control panel at the top right-hand side of the screen. This can be expanded with an orange arrow. When expanded, audio settings and the question option are visible. About the question option, you can send your questions to our team already during the webinar, or if you like, at the end of the presentation for our Q&A session. Written questions will be read out by myself at the end and answered by our speaker. If you experience technical issues and share this via the question form, they will be answered directly in writing bilaterally by our team. There will be a feedback question at the end, the result of which we will not share. After the webinar, we will provide the slides and the recording on the conference website. But now, let me introduce our next presenter. He is one of the most renowned equity strategists in the USA and has a lot of following, not only with US investors, but also here in Europe. In his presentation, he will bridge the gap between the US and Europe, because what's happening in the US right now will have big implications for Germany and Europe. Therefore, this is a topic that every IR professional in Germany should be interested in. He has received numerous awards, including 5 times Institutional Investor Magazine All-Star Analyst in Engineering and Machinery, 6-time Wall Street Journal Best on the Street Award, 6 times Forbes Financial Times Star Mine Analyst Award in Industrials. He's a CFA charter holder since 30 years. Today, he's head of institutional equity strategy and managing director equity research at Stifel. Ladies and gentlemen, please welcome with me from Baltimore, USA, Barry B. Bannister.
Thank you, Henrik. I appreciate the invitation. There is a slide deck that goes with this presentation, and I believe that it'll be, there it is, presented on the board. As Henrik said, I do mostly US equity strategy, but obviously it's a big global world. We have to be aware of everything going on, from the European Central Bank, from the People's Bank of China, to the Bank of Japan, as well as all of the respective governments. Sometimes it's hard to separate those two. They operate very closely together in this new world we're in. But I will approach this more from what issues we think matter most for the US and world markets, particularly the equity markets, but I'll touch on interest rates and how it affects us. And valuation and some of the shifts going on with respect to government involvement in the economy. The first point I'd make is that the market did pretty much as we expected. We were caught off guard by the COVID crisis in February of 2020, but it lasted about a month. The market fell from the 19th of February to the 23rd of March and began a sharp recovery. On the 19th of March, about 3 days before the bottom, we turned very positive on the market. We had a 2,750 S&P target, up almost 20%. And we had that target for only a month and a half out, April 30th. And to do with some seasonal The market rallied very sharply 3 days after our call. We raised the target. We kept raising the target. Last summer, we expected a sideways consolidation with some corrections of about 13%. We actually got a 10% correction during September of 2020. And then on election night, when we realized that there would be government spending, fiscal policy, which has been lacking in Europe, as you know, in addition to monetary stimulus, that you get what's called two barrels or double-barreled gun, where you shoot a lot of stimulus into the economy. So we raised our target. The market was then 3,250 or 3,300. We raised our target for the S&P 500 index to 3,800, 500 points by April again. So again, another short-term 6-month target. We hit that target in 3 months. And I have declined to raise the target. I think in this 3,800 range, plus or minus a few percent, I think the market is fairly fully valued, and what's shifting in the market is not necessarily positive for investors. Higher taxes are probably coming. Efforts to reflate, which will eventually affect your valuation multiple, which is called the price to earnings multiple, PE ratio. And also the difficulty, as you know, fear comes on quickly, such as the virus, but it's very slow to recede or leave. So it comes quickly, and then it recedes slowly. So there was not going to be, and there never was going to be, a sharp recovery beyond the initial bounce back after the bottom. So this will take time. The government changes in the US are more fiscally expansionary. However, there is a great deal of political strife in the US, far more than Germany. And I've been following Angela Merkel and the changes there and the designated successors and so on. This is big. The US is in almost a civil war. And it's about 50-50 divided. And I do not think that what's been happening lately is going to be terribly positive for that outlook. President Biden came in and did more executive orders than Obama, Trump, and Bush by far. And they were very partisan. So there's going to be a lot of strife in the US politically. It's don't listen to the papers that tell you things are well here. There is a great deal of conflict. So with that in mind, the Federal Reserve is waiting for the government to do its part to spend more money, to stimulate the economy so that they can keep doing their quantitative easing, their QE, and that will take time. So we have headwinds to getting above 3,850 or so on the S&P. Valuation could come under pressure, meaning earnings up, valuation down, and the net effect is flat. And over time, there might be reflationary success, but that's never been terribly kind to financial assets. So if you go to page 3, I have a chart there that shows on the left the stock market since 2016. This is the big cap US stock market, the S&P 500, by far the largest single index in the world in terms of market cap. And you can see this widening amplitude. Amplitude is this up, down at larger changes. This widening amplitude, I mean, I have a chart on my wall here, 150 years of market and economic data. I don't see a pattern like that in 150 years. This down larger, up larger, down larger trend that we've been in has a lot to do with Federal Reserve changes in policy. So we knew going into 2018, on the left, you see that there would be a Fed tightening to offset the tax cut. And we had corrections. Then when Chairman Powell in December 2018 2018. You see December 24th, 2018 in the middle bottom pink circle, that there was a bottom. He pivoted to an easier policy after a 20% decline in the fourth quarter of 2018. We had a sharp rally until the COVID crisis, February 19th of 2020. A very sharp drop, unprecedented in my career, and I believe one of the worst, if not the worst, in over 100 years in a short period of time. And on 23 March, 3 days, 2 days, two or three working days after our call of the bottom, it bottomed, and it ran up to September. Now it has bounced, but it's still tentative to me. I'm not interested in raising that target again around 3,800 plus or minus. The other concept in the market you have to understand is, what is your company if you're an IR? Are you value or are you growth? Value companies tend to be financial companies, energy companies, basic materials companies, industrial companies, real estate investment trusts, some utilities. What they do is they give you your cash flow now. They give you very short-term cash flow, very good earnings or big earnings, big cash flow, big dividends. They don't grow as fast, but they can give you cash sooner. Or are you growth? Technology consumer discretionary, like retailers like Amazon, Tesla, semiconductors, software, hardware, cell phone makers, Apple. Those are growth companies, and what they promise is very long-term growth, usually very distant in the future, like biotech. And that cash flow will come much later and depends very much on low interest rates, particularly low interest rates after subtracting inflation, what's called the real interest rate. And when that is growth. And the right chart on 3 shows value, again, think of banks or industrials, relative to growth, think of technology or online retail. Banks, value relative to growth. Now, if you're value, you've done very poorly for the most of the last 4 years. You can see that the drop from the end of 16 to the end of September 2020 was 50%. Underperformance. Investors had very little interest in those names. They wanted growth, 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 growth. But now we're trying to break out again for the 3rd time in 4 years. 2 prior fails, labeled value fail. And we'll see, but I'm not convinced this is the turn. I'm hopeful because it's a more balanced market, but do not believe if your industrial or your energy or your bank is up, that it's going to last until it firmly breaks out, in which case it could be very strong for a long time. Now, some of the major factors in the market are, the main factor in the market, in my opinion, has been liquidity. You see on page 4, we have liquidity as shown by the US money supply. The 3 types of money are M1, which is very conversive to money that can be accessed very quickly in a currency or checking accounts. M2, which includes savings instruments, small time deposits like certificates of deposit. And M3, which is corporate cash, euro dollars, repos with non-banks, very large time deposits at a bank. We had a $4 trillion surge since COVID. Thank you, Federal Reserve. Thank you, fiscal, but mostly Federal Reserve. And that money is not needed by the real economy yet. And so the money has to go somewhere. And excess money always goes into asset prices before it's used in the real economy, the actual economy. So we had a very strong rise in the market. If you go to page 5, let's look at money, and let's use M2, which is fairly broad. And let's look at the entire world's money supply, all of the euros, all of the yen, all of the Chinese yuan, all of the British pounds, all of the US dollars, all of it. Converted into dollars at every day's exchange rate. This is the global supply of money expressed in dollars growth rate on the top. And you see, since the financial crisis of 07, 08, 09, there have been 1, 2, 3, 4, 5, 6 bursts of money growth, typically peaking around 20%, which is not remarkably where we were a little over a month ago when the stock market stopped rising as strongly. And if you look at the bottom, whenever there is growth of money in this period since the crisis and financial crisis of 08, excess money always translates into stock market gains. If you go to page 6, I circled on the top periods of slowing money growth, which I think one is starting to begin. The Federal Reserve has no interest so far in raising its quantitative easing, or QE. The European Central Bank looks a little bit topped out to me. The Bank of Japan has done almost all that they can do. And the Chinese have stimulated quite a bit, but they're paring back their stimulus. So if we slow the growth of money, we probably slow, on the bottom chart on page 6, the growth rate of the stock market. The average growth during periods of slowing money growth for the last 10 years, 12 years, is 3% a year. 3%. So on 3,800, you're talking about 100 points, topping out. Entirely possible. Now on the virus, I guess I can't add a lot on page 7 to what's already known, but we've been using this same chart for a very long time. This has always been about vaccines versus herd immunity. On the right, what I did is population adjustment. I raised the death rate from each pandemic in the last century in America for the growth of population. If there's 330 million Americans now, and there was 110 million Americans 100 years ago, then you have to triple, because you've got 3 times more people. You have to triple your deaths to be comparable to today. Now, the great flu pandemic, before we had widespread antibiotics and other causes exacerbated the problem, killed 2 million Americans. The Wuhan, China origin COVID-19 2020 virus has killed approximately 400,000. A little more, probably a little more if they classified them correctly. The 1957-58 flu pandemic, which was the only one in most of our lifetimes or memories that was anywhere near as bad, was a 1.5 year pandemic that in today's terms was about 221,000 people. So this is bad. It's very targeted, elderly and sick, but it will keep going, unlike the flu, every single year, particularly in the winter, for years, unless the vaccines work. And how that affects people's sentiment, I don't know. I'm a realist, I'm an analyst, I don't have emotion. I tend to do very well at bottoms because I lack fear. I don't do as well at tops because I lack exuberance, excitement. But what I do know is that the market is going to have to adjust to this. So I would only add that if you look at the left chart, the black line, winter seems to be very bad. Summer isn't great either because people come inside, it's hot, they congregate, they make each other sick. But winters are going to be bad. Not just this winter, but probably next winter, depending on vaccine rates. But the death rate is slowing. It's down to about 1.7% of all diagnosed cases. So hopefully that will go down. Now back to the market. I think page 8 is interesting. If you're looking for something that would help symbolize a recession, that helps you predict a recession, if you're a corporate talking to your chief financial officer, there's nothing better than this chart. We tested everything available on all of our computers, and it is the 50-day average. So think of a rolling 50-day average of 50 days of data, take an average. Every single day, you add a day, drop a day, so it's a 50-day average of the 10-year minus the 3-month, the 10-year Treasury note minus the 3-month bill. And what you see is that those days in which the 50-day moving average is upside down, meaning the short rate is above the long rate. The short rate is above the 10-year yield, upside down. Then that predicts in the box for the last 53 years, 8 out of 8 recessions with a mean and a median, meaning the middle and the average, of 10.5 months of recession. So as you see on number 8 on the bottom right, on the 20th of June, 2019 in the box where there's an arrow, we knew on the 20th of June 2 years ago, fully 8 months before COVID, that we risked a recession by the spring of 2020. We had no idea the cause. We just knew that the yield curve, which is very smart if you think about it, all bond traders are smart. You know, we used to have a saying when I was cycling between bonds and stocks that bond investors are smarter than stock investors, because the most they ever get is their principal investment back plus a little bit of interest. Stock has all the upside. So bond people have to be smart because they need to get their money back. And the bond market is where you go if you want advice, not the stock market. So the bond market told us that. Now the implication of that is on page 9. Page 9 shows the earnings starting on the very first day of those 8 times that the 50-day average of that yield curve inverted. So the red, the first day of the red, the prior 8 times. I index the earnings of the stock market to that day, 8 times. And you see that earnings are fine approximately 240 days after the inversion. And we were in the dark blue this time, fine, through March of 2020, fine. So June of 2019 to March of 20, earnings were great. But then we were hit for over 20%. What you see in this chart is that there is no precedent in 55 years for earnings to recover sharply the next year, 2021. Notice how every dotted line is flat. We have a recovery from the bottom to the top of the range, and we are 11% below the street. So when you talk to investors and you see them getting too excited about their earnings estimates, pull them back in a little bit, because we don't know how this year is going to go. The virus could be this mutant strain and surge very strongly in March, hundreds upon hundreds of thousands more cases and shutdowns and governments slow to reopen. We could have a failure of fiscal policy in the US due to this political divide, and you do not see that in the European press because it is propaganda. When you read the European press and the American press, they are all in. They think it's going to be great because they're happy with the election result. But they're not telling you the truth, and the truth is there is a great deal of battle in the US. So we don't know the fiscal and the virus and consumer reactions, or even the bankruptcy potential of 2021 yet. And it makes sense to be cautious on your earnings estimates. Now, at this point, let me switch into one of the reasons why I think the market is fully valued. If you go over to page 12, the way we look at market valuation is this bottom box. We take a 10-year average of inflation-adjusted earnings per share. You should do this with your own company. 10-year average, inflation-adjusted. So you know, money 10 years ago is worth more because 10 years have passed of inflation. So increase the earnings by the inflation. And right now, the S&P 500 earnings per share after adjusting for inflation for the last 10 years are about 117.81 on that right-hand side. And the market is 32 times that, which is very high. Let's see how high. Go to page 13. This is the price to earnings ratio of the US S&P 500 or large cap stock market every single month since 1920, 100 years. And you can see that, and many European markets are cheaper, but they're cheaper because they're value oriented, and value is cheaper than growth. So growth is expensive. But you can see that on that trailing 10-year average inflation adjusted earnings multiple, price divided by 10 years of real earnings, that we are at the level we were at where we started a bubble in 98, 99, that first major spike before the circle. We topped here in 1966, and then we had the Vietnam War and the Great Society, social spending. It sounds very familiar with today. The war on carbon, the war on the virus, and a lot of government spending on social programs. And we went down for 15 years after that on valuation after 1966. We were here in 1936. I remember that one. I'm actually 100 years old. You know, we had a tax increase and the Federal Reserve tightened policy, and we had a second depression. And we were here, the last one is the first spike there in 1928, 29, in the roaring 20s, when the stock market had a bubble and led to the crash of 29. So you were in the upper atmosphere. If you go to the next page, 14, I show those periods where I just described. Very hard to exceed these levels. Now, if you go to page 16, let's look at it another way. About 20 years ago, I decided to switch into strategy eventually. I did more macro work because I made a call 20 years ago that we would have a commodity cycle in the 20s, meaning 2000 to 2015. Up until 2000, all you wanted was technology stocks. AOL, Cisco, Dell, Nortel, WorldCom, it was technology. And we said that if you take stocks relative to commodities, so S&P 500 divided by commodity index, so paper stocks divided by hard assets, oil, copper, gold, nickel, stocks divided by commodities was following an uptrend, as you see here, for 130 years, since 1910. But it peaked then and, of course, fell for 15 years, and our call was right, and that's why people know me. We're back up there again. If you go to page 17, you see that we are at very high levels outside of what's called 1.5 standard deviations above a polynomial trend. That's a lot of math talk, but the trend is slopes up, and we are 1.5 standard deviations outside of it. Again, we have been here 4 times in 100 years. I put arrows. every one of those times that we were here was on the prior page, where I said the late 1920s, the 1966, the late 1990s. Now, it is actually ticking down slightly, which I find interesting. I think we have a very good chance that we are topping out here. And you have to make money by picking stocks, probably rotating to value, and don't count on strong returns. If I may, I'm going to go backwards instead of forwards just for 1 second and show you a chart. If you go to page 15, 1-5, there's our chart again of your price to earnings multiple. It's the CAPE multiple, the PE on trailing 10-year average real earnings. Same chart as before. What I did is I drew a pink parallel line to the trend. And that pink parallel line is where we are right now. And to go above it are the pink areas on the top. Those are the months that we were above today's valuation in history. So what I did on the bottom chart, which I think is fairly interesting, is along the horizontal bottom axis, that is the next 10 years, the forward 10-year return of the S&P 500, price plus dividends reinvested, price and dividends, annualized. So you made, 18% a year the next 10 years, or you made 12% a year, or minus 3% a year the next 10 years. On the up and down axis in the bottom chart is the PE ratio on 10-year average earnings, real earnings. So the pink dots in that chart are the pink area in the top chart. So the bottom chart pink dots are pink areas on the top chart. And what you see is that from this valuation, you are very likely to make 2% plus or minus 5% the next 10 years. The very best case scenario is that you make 7% returns. The worst case scenario is that you lose 5% a year for 10 years. And that's a big hit. That's bad. I doubt it's 7. I think it's probably closer to 2 to 5. But that is not even a third of what people made the last 10 years. We made over 15% the last 10 years, compounded per year. So when you talk to your investors, tell them, the world has changed. Don't expect double-digit returns going forward. Now, going back to this whole value versus growth on page 19. 19 is a summary. On 19, I list the value versus growth. So value would be the blue bars, financials, industrials, utilities, basic materials, energy, and real estate. Growth is clearly technology and consumer discretionary, the 2 red bars, the big tall ones. So your battle is between a broad market and a very narrow market. I think it's good news for the broader market because more stocks will participate, albeit not as good a return as growth stocks give you. And if I could show you one chart that I think is fairly interesting, it's page 21 on value versus growth. On 21, I show US commodity prices. This is your 10-year annual growth rate. So it's the growth rate of commodities over 10 years, every month since 1805, so 215 years. And what you notice is they go up and down. In statistics, it's roughly what's called a stationary series. It varies around 0. So commodities are flat or they're up or down about equal time. On the red, we have all available data for value versus growth, industrials versus technology. value versus growth follows commodity prices more closely than any other variable. And for 100 years, we have data since the 1920s on value versus growth. If we are coming off of a bottom in commodities, which I spend most of this latter part of the deck saying, yes, we will, then you want to own value over growth. You want to be cognizant or aware of your price to earnings multiple that you're paying going forward. And it's going to be harder to make money in that environment going forward. Now, a couple of other charts I wanted to show you. One is about currency. On page 23, we have a bad environment, I think, for people. If I'm going to try to lower the dollar, I'm essentially raising the euro. The country with the most deflation strengthens the currency. So Europe looks like it has a lot of deflationary pressure because of a fairly imperfect union that's not a transfer union from north to south. America is a transfer union where New York subsidizes Alabama. And if we're going to debase the dollar through monetary and fiscal expansion, yes, it provides liquidity to the world, but it will raise your price of commodities. So our food prices, our energy prices, and our floating interest rates are going up. So this green line here is disposable income, income after tax, minus food, energy, and floating interest costs, me, people. And if we're going to drop the black line, the real dollar, we're going to drop the living standards of Americans as we did in the prior two instances. Now, you and I, we all have decent incomes, and so we don't feel it as much. But average people in the bottom 50% are going to get hit hard because the cost of groceries, even Aldi, which is a great store, the price of energy, and the price of floating rate interest like credit cards or second mortgages or personal loans is going to go up. And our income after paying for that is going to go down. The other thing I would say before I do Q&A is if you go to page 35, I'm very far ahead now, 35. On the left is a fascinating chart. What it shows is a black line, and the black line is how much more nominal GDP. This is price plus inflation, or inflation plus units. So nominal GDP, not real, but nominal. So it's inflation plus real growth. How much more nominal GDP do I generate for every $1 of new debt? And debt, as you can see on the pink area on the left, is called non-financial debt. That is household debt, government debt, corporate debt, and non-corporate business, private business debt. And you can see it's stepped up since the Reagan era 3 times. Once in the 80s with the commercial real estate, the savings and loan crisis, the corporate debt, the LBOs, the takeovers. Again in the 2000s with houses and mortgage debt. And now a third time with government debt, mostly federal debt. And the black line, as you see, since 1962, since John Kennedy was president, the black line goes down. We used to generate on the left axis, the vertical up and down axis of the left side of the left chart, we used to generate 80 cents of GDP when we borrowed $1. In the next cycle, we generated 50 cents of GDP when we borrowed $1. And in the last cycle, we generated 30 cents of GDP when we borrowed $1. And Washington wants to borrow a lot of dollars, and the Federal Reserve wants to buy them. So what we're looking at is by the year 2035 to 2040, we will generate 0 GDP for $1. If you are simply borrowing to pay interest on old debt, you have to do 2 things. One, you have to cap interest rates, which destroys the wealth of lenders. And 2, you must generate inflation so that your nominal GDP grows faster than your interest payments. I guess third, you have to lengthen your maturities longer term. And the Federal Reserve has been buying as much long-term debt as possible. Because technically and actually, you're bankrupt in 2035 to 2040. You're getting no growth from $1 of debt. You should do this chart for Europe. It would be ugly. It doesn't look good for China either. On the right, we see one of the reasons for that, and that is births. These are American births every year, millions of births every single year since 1915 in green and red. The green is the births. Focus on that. The baby boom, which was born 1946 to 1964, 90 million Americans. The middle baby boomer was born in 1958 and is about 62 years old, retiring. If you move the births forward 80 years to the red, so I've become 80 years old. I'm 120, so 80 is young. 80 years forward on the green, you see that the peak deaths for the baby boom occur in the late 2030s. Half of the boomers are dead and half are dying. And the fact of the matter is, most of the wealth is held by the baby boom, not the younger people. And so we're going to see taxes on wealth through estate taxes when you die. But we're also going to see that half the problem is gone and the younger people are going to choose to inflate. Inflation is a choice. And the value of paper money will go down, which is why Bitcoin is going up and gold went up. So that is the future. And then let me wrap up and then I'll do Q&A. I have just 2 minutes on one last slide on page 36. On 36 is a list of companies that America called the Nifty 50. This was in 1972. They had been very strong for 10 years. They were very strong stocks. They were very fast growing. They were solid companies. And people said, buy them. It's only one decision, buy them. Because they will grow earnings, grow dividends. And they said, buy them. Don't worry about the price to earnings multiple. But as you see, the price to earnings multiple in that yellow, just at the bottom on the just after Nifty 50 median, it says 36.2. The middle company on the 50 list was 36 times earnings. The market was 16 times. They were almost 2.5 times more than the market. Today we have technology stocks that trade at very high multiples, and people say buy them because they will grow. Growth is not enough. As you can see, from 1973 to 1982, we had an impeachment of a president, almost. We had a resignation. We had a war in Vietnam come to a conclusion and a Cold War go up a lot with Reagan and Nixon. We had a huge inflation pressure. We had a compliant Federal Reserve that pushed inflation. And over the next 10 years, despite those companies growing their earnings faster than the market, that first red arrow there where it says total return, those Nifty 50s gave you about 3% a year. The market did almost 6.7. Growth is not enough. If you get the macro environment wrong, just because you grow your earnings, it's not enough. Your stock won't go up. because your price to earnings multiple will go down. And that's what I'm here for. I talk about the world of the next 10 years and the next 20 years and how it's going to play out. And this deck you have, this slide deck, just 36 pages, describes the next 10 and 20 years. And I didn't go through most of it, but you see what we're talking about. So thank you for listening. I'll do Q&A now. Matthias has the, I have the ability to read questions here if there are any.
Let me do that for you, Barry. Thank you very much so far for your very interesting perspective. We do have quite a few questions already. So let me just start top of the list. The Fed announced that interest rates will be lower for longer. Where will all the money go to? Value stocks, growth stocks, or other asset classes? What's your view?
Well, if they keep rates lower for longer, they are trying to generate inflation. They will probably steepen the yield curve, meaning the 10-year yield will go to eventually, our work shows, almost 3% by the middle of the 2020s. But at 3% curve, which is where we stopped, we will peg the short rate lower and the long rate will go up to 3 and the curve will steepen. That at 3%, valuations will come down and earnings will go up, valuations down, market flat. It's more value. So I would say, obviously, value driven if the Fed keeps lower for longer and sticks with it. Now, the problem for the Fed is exiting. The moment they say the slightest word about lowering the QE, the quantitative easing, or reconsidering short-term rates, I think the market would have a significant negative reaction. So they're trapped in their own policy. But value is where you would go.
Thank you, Barry. Next question, referring to page 9. If you can go back to page 9, please, colleagues. What was different in the year 2000, as it's the only curve that goes up after 90 days?
2000 was a very specific recession that hit the capital spending of the technology and telecommunications complex. There was a negative wealth effect from the drop of the NASDAQ tech bubble bursting. By the way, the NASDAQ went from 5,200 to about 1,100, so it lost about 75–80% of its value. That was a big drop, and so that was very technology specific. Prior to the tech bubble bursting, we had something called a financing gap, meaning corporate capital spending was larger than internally generated cash flow. They had to actually raise capital to spend. And so the financing gap collapsed, the capital spending collapsed, and the market was very concentrated on technology and wealthy people's wealth effect. But the broader economy, average people, ordinary people, they didn't feel it as much. So it was a very strange recession. COVID tends to hit, unfortunately, the opposite. It hits most average people, jobs, activity, income. And the wealthy people have made a lot of money on cheap money policies with stocks going up. So we have a recovery then, and we had a recovery forecast on our dotted line, but we are 11% below the street. And so as earnings revisions come in and they're down, and we think they're down this year, your price to earnings multiple is high and your earnings revisions are down, the market would flatten out at best.
Thank you for your answer. The next question from our spectators. What do you expect for the trade relations between the US on the one side and then Europe and China on the other side?
Well, Europe signed a trade deal with China because Europe has to look outside for demand. They don't have as much domestic demand growth. So I understand that. But Biden wants to build a coalition against China for unfair trade practices, and there's no doubt about that. He wants cooperation between Western capitalist and democratic countries like Europe, like Japan, like the US, like the UK, to work together. Because China has been abusing the trade system for about 16 years. And in so doing, they've caused a great deal of political and economic disruption. I think that'll succeed. China has reached an economic development stage where they actually have intellectual property they wish to protect. China has reached a development stage where consumption is more important than just exporting manufactured goods or doing construction. So China probably is on board, and I think Biden's plan for that will succeed. But we have to work together. I think that's what's going to happen.
Barry, what should we expect when COVID-19 is under control? The next financial crisis?
No, I don't see a financial crisis because the Federal Reserve is, like you said, lower for longer. And the fiscal spending, the government spending is excessive. I think it's very much excessive. We're spending a lot more than we need to. If you add Biden's plan to the Senate passed plan of January, to the CARES Act of 2020, we're approaching 25% of American GDP. So you're going to have a large amount of fiscal spending, and you're going to have a lot of reflationary pressure. But if your real yield, your yield after inflation rises, your valuation, your price to earnings ratio will fall. I make that case in the slide deck. And were you to check, if you look at the future, we are early enough that if the dollar falls, then the growth stocks would underperform the value stocks. Go to page 24 of the deck. On the left side is US differentials on yields. I don't expect a large dollar decline. I think US yields will rise. So the black line is the difference between American and non-US yields. As that line, the black line, comes up just a bit, the dollar will roll over slightly, not horribly, but slightly, but it will keep growth stocks under pressure. On the right, you have growth relative to value in red against the same green dollar line on 24. So growth relative to value, red, will turn down. And as it turns down, value outperforms growth. Price to earnings multiples fall and inflation picks up. The yield curve steepens, yields rise, and it's a gradual process, but it will happen over the course of several years.
Next question. Many think that a lot of money will flow into green tech industries under Joe Biden. How do you see that? And what does that mean for European and German stocks?
Well, energy in physics, if you go through transformations of energy, it's called traversing the energy gradient. So you're crossing over. You take the primary energy from the sun, it goes into the wood, and then you burn the wood. That's one gradient. But the more steps you put in there, which is what alternative energy, green energy does, you're putting more steps in there, or you're doing very capital intensive windmills, very expensive maintenance, or you're having distributed power with solar panels, very distributed. It's very hard to replace the existing infrastructure of either gasoline for cars, petrol, or conventional energy, natural gas, coal, nuclear. And it's going to cost a lot of money. There's a reason why European electric power costs 2 and 3 times more than American power. They rely more on these other gradient sources that are very expensive. Often they require backup power. So I have a windmill farm, but I also have natural gas generators in case the wind stops blowing. So I'm duplicating my capacity. So as the power cost goes up, as I said before, the standard of living of ordinary people goes down. And unlike heavily urban, smaller countries like Switzerland or Germany or France, the US is very dispersed with large areas where you can drive 120 kilometers per hour for 2 hours through the desert and not see people. So moving power around and moving cars around is very expensive. And I think it's just going to drive up American costs to go to alternative energy. But it's the equivalent of a war. In a war, you blow up a bridge or you blow up a rail line, and then you have to rebuild it. And it generates GDP in a Keynesian sense. We're just going to have to rebuild everything, and it's going to be very expensive. And so, you know, I said that the social programs in the war lend me to the commodity cycle. One last chart on that comment. If you go to page 31, this is commodity prices and where we are now. As you can see on the last blue dot at the bottom, April of 2020 was the bottom. We are going up. And as we go up on the commodity price growth, then approximately one generation later, you have a conflict, a peak of inflation. So the rise of China, the inflation of assets and debt, the Cold War, 1980, inflation peaked at 14%, World War II, World War I, the US Civil War, the Napoleonic Wars, the War of 1812, that some sort of war on climate, the war on this virus baby, combined with the tension with China between the US and the Thucydides trap. It's called the Thucydides trap. Graham Allison, read the book. I think that the years in the 2030s are going to be quite awful, much like the 1970s in a way. So the 2020s are our last chance to avoid that, but I don't think we will. Next question.
You for because questions are quite different. You mentioned Bitcoin, Barry. What's your opinion on its ability as inflation protection?
It's far too volatile to count on as a currency at this stage, but the advantage of Bitcoin is that the ledger doesn't require a middleman to ensure honesty. So it bypasses the trusted third party, the bank, the trustee, the lawyer, you know, because the contract is recorded in the blockchain. The other advantage is it's finite in quantity. You know, it's like the gold standard, where you had a limited amount of gold and you couldn't find it fast enough, and as a consequence, it held its value. So it's got those traits, but as money, it's too volatile at this stage. It's also not sure how it's going to be taxed on a transaction, because government will not surrender their currency power, called seigniorage, easily. So government will fight back. So you're buying something that you know one day the government will kill it or try to kill it and replace it with central bank money. And that's central bank electronic money too, which is coming. But the beauty of Bitcoin is that it benefits from both sides of equity risk premium, earnings yield minus the real yield. In other words, negative real interest rates out to 10 years, money has no value, it's a negative value. So Bitcoin competes against a very weak money. So Bitcoin goes up. Conversely, Bitcoin benefits from the earnings yield in equity risk premium, which is to say, the higher the PE multiple goes, the price to earnings multiple, the higher it goes, the more speculation there is, the more driven by liquidity it is. Bitcoin benefits from that. So Bitcoin's going up on two barrels, two things at the same time. Low value of money, high multiple market. So it goes up when you get that speculative frenzy. I think the price to earnings multiple will bottom and the real yield will bottom, and I'm not terribly interested in chasing this Bitcoin rally, but I understand if people want to because of some of its advantages.
All right, thank you. Second last question. I think we can extend the session maybe for 3-4 minutes. Barry, what's your prediction for fintech companies? Since you separated IT and financials in your analysis, where would you place them? Are they more on the value or on the growth side?
Oh, I think they're more growth. You know, one of my friends is one of the original people who set up the very first internet banks. So the ING Direct was the orange dot. He set up that bank, the electronic technology for it back in the 2 decades ago and built a company around that, setting up banks like American Express Bank. You know, fintech is very real. I think it's very good. Venmo has been a huge hit with young people, even old people like me. I said I'm 120, have adopted the Venmo to send money. PayPal is great if you're buying or donating money to a cause. You just click a button. So fintech is very real. It's very exciting. It's value in the sense that it's financial, but because it's not really dependent on cost of money, it's really growth. But I like it. I like it a lot. It's a very exciting area.
Thank you. Last questions. Very personal one. Which sectors would you put into your own personal stock portfolio with a 3 to 5 years horizon?
Personally, I am significantly overweight. We have to buy index funds because if you buy individual stocks and then you talk about them, and I talk about 500 stocks, so you know, what am I doing? I get in trouble. But I buy index funds. So I bought the international index and I bought the value index. So there's iShares, there's Vanguard, there's others. So value and international, which is a bet on a weaker dollar, a reflation, better nominal GDP, rising commodities, and so on. That is where I'm significantly overweight personally, which is financials, energy, industrials, and materials mostly personally. But as I said, I'm good at bottoms. I'm not good at tops. I got the bottom in 2000 on commodities. I got the bottom in the market in 2020. I've done it many times over the years, even in the financial crisis. I'm not good at tops, and I don't really chase growth because I'm not like leading edge technology. So I was underweight growth and overweight value for over a year before they really started to bottom. And so I think they're going to come back and go up for 8 or 10 years, but it won't be straight line. We'll go. There's a chart in here that shows. Last question. I know you don't want to talk too long on this, but there's a chart that shows where we see value going in the coming years, and I think it's significantly up, but it won't be a straight line. Our best bet, our estimate, is 2020 to 2024. It will go up, then it will correct very hard in 25. Fed exit, very difficult. Political transition, very difficult. Inflation, dealing with the curve, yield curve, difficult. Europe with the euro strong and Italy unable to compete on unit labor cost, very difficult. I think that 2025 could be a very bad year, and then it will come back and really take off. So up for 4 years, down for a year, and then up after that for 10 years.
All right, and I think that wraps it up. Unfortunately, time is flying and it's already up. Thank you very much for your insights. It was an honor to have you. I could listen to you much longer, and I think that counts for the other participants as well. Thank you very much.